Hi, good afternoon, everybody, and thank you so much for joining us during your lunch hour. I'm Sin Ting, Chief Client Officer here at Endowus, and I also have Yulin here with me today, our investment lead. Today, we want to share more about the enhancements that we're making to our income portfolios. So we currently have three income portfolios: stable income, higher income, and future income. So we launched these three portfolios in late 2021 in an arguably very different interest rate environment. Given where rates are today, we're enhancing our income portfolios to reduce the overall portfolio risk, bring further diversification to the portfolios, and slightly reduce the investment costs as well, while maintaining similar target payouts. So if you have any questions today, please go to Slido, sli.do, type in income 2023, and you can put all of your questions there. So that's sli.do, and the code is income 2023. So just very quickly, for those of you who are newer to Endowus, our mission here really is to empower all of us to invest better, to live better, through conflict-free advice, institutional access, and low fair fees. If you look at the logos at the bottom, these are our major shareholders. So Endowus employees still remain the largest shareholder in the company. And we have some major financial institutions like UBS, Citi, and MUFG, venture capital funds like Lightspeed, SoftBank, government-related entities like EDBI, et cetera, and prominent Asian families invested in us. This is the growth journey that we've been on since the launch of the company. So our product was launched more broadly in 2019 when we became the first digital advisor for CPF. In 2022, we acquired a majority stake in a Hong Kong wealth manager called Career Private to become one of the largest independent wealth managers in Asia. We officially launched our Hong Kong platform in April this year. And so if you have any Hong Kong friends, please send them our way. And we are very proud to announce that, we have given over 40 million US dollars in savings back to our clients just in trailer fee rebates in the middle of this year. So today, we manage over 5.5 billion US in assets across the Endowus Group, and we've also raised about 95 million in capital. Our most recent fundraise was this year, where we raised 35 million. Our existing investors had participated in this capital raise, and we also brought a few new investors onto our cap table, including Citi, MUFG, and a couple of large family offices. So on our platform today, you can access some of the world's leading fund managers, and often at the lowest cost. So we offer institutional share classes or rebate trailer fees as cashback. So you can invest in these funds or even transfer your existing holdings to us and enjoy cashback on your trailer fee rebates. So Endowus was really designed as a goals-based platform where we want to help clients achieve their financial and life goals. So we believe that your different goals in life, whether it's saving for a rainy day fund or your retirement or your kids' education, should have different investment horizons and risk tolerance and should therefore be invested in different portfolios. And that's also how we designed our income portfolios. So our investment office has crafted them using a life stage approach, which is tailored to meet our clients' different needs for both passive income and also long-term growth across different needs throughout their lives. So our first portfolio, stable income, its objective really is for very stable monthly payouts and capital preservation, with a payout target of about 5 to 6%. So it's suitable for retirees or investors who need a more regular passive income stream. It's 100% invested in fixed income, and you should expect fairly limited capital appreciation from this portfolio. Our second portfolio, higher income, this targets the highest payouts among the three portfolios, about 5.5 to 6.5% currently, with some capital appreciation and higher risk compared to stable income. It's more suitable for working adults with a higher living expenses, for example, and can also stomach higher risk. So the portfolio has 80% allocation to fixed income and 20% to equities, for clients who want to continue to build wealth with some potential for moderate capital appreciation. And last but not least, future income. This targets the highest capital appreciation among the three portfolios, but also the highest risk. So the payout target now is about 3.5 to 4.5%, and it's suitable for younger adults who are focusing on future important life goals, but would still like some regular income currently to contribute to their monthly spending. But with time on their side, they can also continue to grow this pot of savings to increase potential payouts over time. The next slide, I also wanted to show the historical payout yields of our existing portfolio since the launch, which has been quite in line with the target payouts that we have listed down. So with the changing interest rate environment, the payout targets of these three portfolios have also moved in line. Next, I'm going to pass it to Yulin to talk about our recommended portfolio change for these three, as well as to give her a quick introduction of herself.
Yeah, thanks, Sin Ting. For those of you whom I have not met, my name is Yulin, and I am the investment lead at Endowus. And today I'm going to walk through the recommended portfolio changes to the Endowus Income Portfolios here with you. So as Sin Ting has briefly mentioned, the updates to the income portfolios are actually carefully considered in response to a shift in the interest rate environment over the past 2 years. So what has happened? I think a lot of you might know about this very well. That is, inflation was more persistent than what people and policymakers have thought. And the Fed started raising interest rates in early 2022. So far, it has raised rates 11 times, and the Fed fund rate increased from almost zero to be in the 5.25 to 5.5% range. So bond markets certainly suffered in the past 2 years as the increasing interest rate led to bond prices being marked down. Many fixed income markets, including government bonds, the safest part of the fixed income markets, are in their third year of negative return. This is almost unprecedented in the history of the modern fixed income market. But such brutal correction in the market could be music to ear to income investors actually, especially now as bonds are finally paying higher interest rates. So this chart plots the yield to maturity of different fixed income segments, with the orange diamonds indicating where the yields were 2 years ago, and the bars indicating where the yields are now. Two observations here. Firstly, yields have come up meaningfully across fixed income markets. For example, if we just look at the purple bars, these are investment grade fixed income markets, and they were yielding between 1 to 3% 2 years ago. It was really very low, and now they're yielding between 5 to 6%. And secondly, and related to the first point actually, so there is a worthwhile question for income-seeking investors to consider, and that is it still worth for me to take the amount of high yield and emerging markets risk in order to earn a higher yield, higher income, when investment-grade fixed income is already giving me 5 to 6%? Is the 2% yield pickup worth additional risk in this new interest rate environment? So we have certainly been thinking about the implications of the changes in the fixed income market dynamics a lot for our investors, and we have made key enhancements to our income portfolios as a result. Next slide, please. So firstly, we have made adjustments to the strategic asset allocation to strategically de-risk the portfolios. If you are familiar with our strategic and passive asset allocation framework, we termed it as PAA framework, you would know that we think in terms of long-term strategic asset allocation and in the unit of building blocks. So for the fixed income allocations in stable, higher, and future income, that is on the left-hand side, we are de-risking by reducing allocation to Asian and emerging markets bonds, as well as high yield bonds in the higher and future income portfolios. So the allocations taken from these riskier building blocks, riskier segments, would be added to flexible bond funds. They tend to be developed market focused, average investment grade. They are also able to manage duration flexibly, which tend to add value when duration risk is volatile. And shifting our attention to the right-hand side of the chart, for the equities allocation in higher and future income, we adjusted asset allocation to bring the sector and geographical risk more neutral to the MSCI All Country World Index. For example, a notable adjustment is the addition of US equities building block. Both portfolios were quite underweight the US market and overweight higher dividend paying markets, for example, European markets. So this adjustment would help to neutralize such bias and reduce the active risk that we take in sector and geographical tilts. Moving on, so the strategic de-risking of income portfolios can be seen through their historical performance. This chart plots the historical growth of wealth of stable income. The lesser risk that the new stable income portfolio takes means that historically it had weathered downside periods better than the old portfolio. The two examples labeled out here are firstly the global financial crisis, where the old portfolios experienced a peak to trough drop of 13.8%, and the new portfolio experienced a peak to trough drop of about 11%. And also the recent market correction. The lower risk and better downside protection has also translated to better long-term wealth growth and therefore improved return per unit of risk. And this can be shown in the table. So the same picture holds true for higher and future income as well. And I have plotted very similar charts for higher income here. It is, but you can probably notice a slightly higher downside risk for higher income compared to stable income because it takes additional credit risk as well as a bit of equities risk in order to achieve higher income payout and limited to moderate capital appreciation. But also notice the improvement in the risk adjusted return long term historically for the portfolio after the adjustment of the asset allocation. And next slide, please. And the same thing for future income, but again, notice actually a higher long-term growth potential for this portfolio because of its high level 60% in fixed income and 40% in equity risk. And in terms of the downside, it is slightly higher than higher risk. But again, the new portfolio after de-risking has weathered the historical volatility a little bit better than the old portfolio. Next slide, please. So coupled with the strategic de-risking is more manager diversification within the certain building blocks. Just to go through it quickly, in fixed income, we added 2 flexible bond managers and 1 pure play investment grade hard currency Asian bond manager. All of them have a distinct active management style different to the existing funds, and we believe that will bring incremental value to the portfolios. In equities, we added 3 managers for the new US building block, each with a different, again, management style, as well as 2 new funds for global equities and Asian equities. So as we scaled back active sector and geographical risk for the equities allocations, we are being very thoughtful in introducing potential alpha generation via an allocation to conviction-driven active managers. There is also more variation of fund selection, catering to differing investment objectives of higher and future income. So moving on, the new stable, higher, and future income portfolio would continue to be competitively priced. The next slide, please. Yeah, the portfolio, the previous slide. Yeah, the portfolio updates would bring further cost reduction of 2 basis points, 4 basis points, and 6 basis points, respectively, to the portfolios. It's not a lot, it's not a drastic reduction of fees, but I think it helps to reiterate that at Endowus, we understand the importance of cost to investment results, and keeping costs low is one thing that we pay attention to a lot. So for example, for all the funds on the platform and in the advised portfolios, we either access clean or institutional share classes or return the trailer fees as cashbacks to lower the costs as much as possible. So the strategic de-risking and further manager diversification is achieved while we keep the payout targets the same. There is no change in the target payouts. They will remain at 5 to 6% for stable income per year, 5.5 to 6.5% per year for higher income, and 4 to 5% per year for future income. So if you invested 100,000 in the portfolios, it will translate to the corresponding monthly cash flow. But will there be monthly fluctuation of cash flow? There will be. It's not a fixed amount. Stable income should give you the smoothest monthly cash flow. We expect there to be a bit more variability of the monthly cash flow for higher income. And for future income, because one of the funds pays quarterly, so we expect a quarterly bump in cash flow. But on a yearly basis, it should smooth out quite meaningfully. And another thing to note is that the payout targets are formulated by the investment office here at Endowus, leveraging a comprehensive assessment of historical and anticipated payouts associated with the underlying funds. We try to fix it as long as possible to give you the certainty of future cash flow, but it's not fixed forever as market conditions change. And we review it on a quarterly basis and will make necessary upward and downward adjustments if needed. So here are the details of the fund allocation changes for each portfolio. I won't spend too much time on these as we have gone through the fundamental rationales for these changes. And you will be able to find such details as you go for your Endowus portal to accept the changes. And again, I just want to reiterate the perspective of thinking about it in terms of building blocks. It might seem to be quite a lot of funds, but actually they can be bucketed into different building blocks. That could be, and I have talked through the changes in the building blocks. So for stable income, overall increasing flexible bond funds taken from Asian emerging markets funds to de-risk the portfolio is lower cost. The next slide. For higher income, increasing flexible bond funds taken from Asian emerging markets and high yield bonds, adjustments to equities allocation to reduce structural biases, overall risk is reduced and slightly lower cost. And moving on to future income, similar narrative to higher income, but we do have 20% allocation to accumulating equities here, split between 3 fund managers, Dimensional, GMO, and Amundi, that's the last 3 lines, in order to achieve a moderate long-term capital growth potential alongside some income generation. So I will quickly go through the portfolio characteristics changes with you, and they really just reflect the key enhancements that we have made to the portfolios. Let's first look at the sector allocations for the fixed income parts of the income portfolios. So the shaded areas are old portfolios, and the solid areas represent the new portfolios. And notice the reduction of emerging markets debt across all 3 portfolios, as well as reduction of high yield corporate for higher income portfolio. There is an increase in securitized credit as a result of allocation to flexible bond funds. Most of it is actually to the agency mortgage-backed securities. They are very high quality, backed by US agencies, and managers are seeing attractive relative value opportunities there. Moving on, the yield to maturity and duration are 2 key metrics that fixed income investors look at a lot. So yield to maturity measures the total return potential, which means both the income plus the capital appreciation potential of a fixed income portfolio on a forward-looking basis. It is different to payout yields, but it is usually correlated because the higher the total return potential of a fixed income portfolio, the more the manager could afford to pay part of it out as income to investors. And interestingly consistent with the increasing interest rate. So the gray bar actually indicates the yield to maturity of the income portfolios 2 years ago. And compared to 2 years ago, the yields for income portfolios have come up meaningfully, almost 3% in the past 2 years. And even with the move up in credit quality and a reduction in regional risk, the yield to maturity and duration of the new portfolios are comparable to the old ones. So note that these are only for the fixed income parts of the income portfolios scaled to 100% for an apple-to-apple comparison across the portfolios. But for higher and future income, there is also a component of equity allocations as well to cater to the needs for some long-term capital growth. And now let's look at equity parts of higher and future income portfolios. So this chart plots the geographical weights relative to the MSCI All Country World Index. And negative means underweight, positive means overweight. The more the overall underweight, the higher active geographical risk the portfolio is taking. And the equities allocation of the portfolios historically have had a bias towards dividend-paying markets and stocks. And hence you will find previously that there was an overweight to Europe and underweight to the US. So we have reined in these deviations meaningfully in the new portfolios. And for future income, we have also tightened the overweight to Asian equities. Moving on to the next slide, a very similar picture for the sector allocations. In particular, the portfolios were underweight technology, which tends to be a bit growthier and pays less dividend, and overweight utilities and real estate previously because they were historically the higher dividend sector. So we have managed to reduce again the active sector risk by reducing these structural biases. And that wraps up the walkthrough of recommended portfolio changes. And I will hand it back to Sin Ting to talk about how you can opt in for the new Endowus Income Portfolios.
So for clients that currently already own one of the 3 income portfolios, you should have received this email this morning or coming today on the recommended portfolio change. And if you want to go ahead to opt in, what you can do is log into your Endowus account. You can either click on the notification icon and then click review recommendations, or you can click on the specific goal, go to manage goal in the top right and click view recommended changes. You can read through our rationale of why we're making these changes. And if you want to go ahead and accept it, then you can confirm via SMS OTP. So after you accept the recommended portfolio change, what happens is that we will redeem the funds that are no longer part of the portfolio or that are underweight to the new target asset allocation, and then reinvest the proceeds into the new funds to align your portfolio to the new asset allocation. At the same time, we'll also take this opportunity to rebalance your portfolio as part of our added service. And this whole process will take about 5 to 10 business days to complete. So during this time, you can still continue to invest and partially redeem from this goal, but you can't do a full redemption until the whole process is completed. So you can take your time to understand why we're making these changes, and you can go ahead to accept the recommended portfolio change at any point in time, or you can also choose to remain in your existing portfolios. And if you have any questions as well, during this process, please feel free to reach out to the team at support@endowus.com, and we're always happy to answer any questions you have on your portfolio. So that's all we have for the webinar section. We want to move on to Q&A now. And for those of you who have questions, please go to Slido, sli.do, put in the event code income2023 to put any of your questions. And also for the existing questions, please also feel free to upvote questions that you think are the most pertinent so that we can always also prioritize which ones to look at.
Yeah, I see that we do have some questions on Slido. Maybe I'll just, it's not a lot. I'll just start addressing some of the questions. Well, the first question, does it still make sense to invest in income portfolios if you don't actively need income at the moment? To be honest, I think if you don't really need income, it's better to reinvest your income to accumulate your wealth over the long term. So that's the principle that I will hold on to. But in terms of what portfolios you would like to invest in, well, you could actually still invest in income portfolios, but reinvesting all the distributions that you have received. It might be also worth considering, our flagship fixed income portfolio, which actually is built to the long-term wealth accumulation goal. because fundamentally the income portfolios are optimized to those income-seeking investors, and therefore it would, for example, tilt towards higher income-paying sectors and also higher dividend-paying sectors, and this might be something that you want to consider when selecting the portfolios.
Yeah, maybe just to follow on to Yulin's point, we really encourage clients to think about what their goals and what their needs are before deciding on which portfolio to invest in, because a portfolio that choose should really come from what these needs are and therefore what the investment horizon and what the risk is. So if income is not a priority for you at the moment, like what Yulin mentioned, then it makes sense to look at, some of our wealth accumulation kind of focus portfolio, which is our flagship, for example.
Yeah, exactly. And I guess the underlying assumption maybe for this question is that people are seeing fixed income market to be attractive, and therefore people are looking at, maybe some people are looking at income portfolios because of this. But we have more fixed income portfolios on the platform. It's not just income portfolios that have fixed income allocation. Okay. Let's see.
There's a question on, in terms of making the portfolio changes, we have reduced the allocation to high yield, but why are we reducing the allocation for Asia as well?
Yeah. Yeah, I think the starting point for this is that we need to understand actually previously we had a pretty big structural bias in terms of overweighting Asia in our portfolio. And there's a reason for it, and that's because 2 years ago when the developed markets generally were not really yielding much, Asia gives us the yield pickup. So in stable income portfolio, we allocated 30% to Asia investment grade in order to achieve attractive enough level of income payout for our investors. And the dynamics has changed a bit right now. Maybe we can go back to the first chart that I showed to people, the different yield to maturity. Yeah, so if you compare, just up a bit, yeah, this one, yeah.
Oh, sorry. Okay.
Yeah, so if you compare, for example, the yield to maturity of Asian investment grade to, developed market peers, there's not much difference anymore. And fundamentally, Asia is a smaller part. It's a part of a global fixed income market. We still think it is pretty attractive, especially investment grade part of Asian fixed income market. And long term, it has, delivered pretty good risk adjusted return. But it's worth actually reducing our overweight in Asia relative to DM, because there is still the regional concentration risk that we are taking here previously in order to achieve the yield pickup.
Maybe just as a follow-up to that question as well, I saw a question on Slido about the average duration, total expense ratio, and credit ratings of these three portfolios. So I think average duration and TRs have already been addressed as part of Yulin's presentation. Maybe you can elaborate a little bit more on what the credit ratings are.
Yeah, I guess the question is specifically asking about the fixed income part of the portfolios, because we do have equity risk in, and there is no credit quality for equity components. But all three portfolios will be investment grade rated. Maybe we can go to appendix. I do have a chart that shows you the credit rating distribution, and it's also in our insights article. So it's no. If we can go up. Yeah, it's okay. Never mind. I think this one, yes. Thanks. Yeah, so actually you can look at the blue part of the bars. Those are high yield credit. So you can see in stable income and future income, it's pretty limited, less than 20% right now. High yield rated bonds. So overall is quite high quality and investment grade. There's of course more high yield risk in higher income, but it's still less than 40% in total. So it's still average investment grade. All right. There is a question on is de-risking required now that the Fed is expected to reduce rates from fixed income perspective? Well, good question. I think first of all, actually, this is a pretty tactical call. If we are trying to time when the Fed is going to cut rate, and overall, I think the big picture is that interest rate has come up and there is room to improve risk-adjusted return. Because even though we're de-risking, if you look at the yield to maturity, it's actually there's not much change between the old and the new. And another thing is the duration is also actually pretty much the same. So if you really want to think about it from a tactical perspective, okay, if Fed is going to cut rate and there will be capital gain on the fixed income markets, duration is the metric to measure that, right? So the sensitivity is still the same. It's not going to impact that much. And another point is, I think the economy has really surprised us on the upside this year. People were actually expecting recession from I don't know, end of last year already. They say this year, 2023, there will be a recession, but it still hasn't come. We don't know whether it will come, but the effect of high interest rate is probably delayed, but it will eventually weigh on companies and on the fundamentals. So risk assets had a pretty good run, to be honest, this year, and yeah, in the future, I think it's still good to still be optimistically cautious in terms of the positioning, and also, of course, in response to the broader shift in the interest rate environment. I think the changes make sense.
So, a question on comparing the income portfolio and cash smart. So the question is, if I were to reinvest the payouts from the income portfolio, is it going to be the same thing as a cash smart portfolio since the returns are reinvested? Income and cash smart are quite different investment products. So cash smart is really for managing your very short-term liquidity, your rainy day fund, where you cannot accept much volatility. And the different cash smarts portfolios are made of money market funds, cash funds, as well as very low duration bond funds. And the income portfolios, as we have talked about, are really meant to be, longer term investments for clients where where payouts are a very important need for them. And depending on which portfolio you invest in, some capital appreciation as well. So I would say that the risk, the duration of income portfolios versus cash smart are very, very different, and you should pick between these two based on what your needs are. So just to share for my own portfolio, for example, I use cash smart for my mortgage payments, for my rainy day fund, and for cash flow needs that I know that I need in the next kind of 1 year or so. Income portfolio for me is really for my longer term needs. I'm looking at, for example, kind of a 5 to 10 year horizon personally, and that's what I use the income portfolios for. It's for money that I know I will not need to take out during this period, and I want to generate some kind of payout target for me for my monthly expenses. So they're for quite different needs for myself.
Yeah, and I think I've also shown you the peak to trough drawdown of income portfolios, and they're in the range of double digits. And it's very different to cash smart portfolio that is, very low single digit peak to trough drawdown if it ever happens, and the recovery is also much faster. So the risk is very different. Let me see whether is there portfolios in USD? Yes, we do have USD portfolios. I think it's currently you have to probably ask a CX advisor to advise you on this. We don't have it off the shelf on the platform yet. We do have USD single funds, so you can actually just go and search for the single funds and build your own portfolio in FundSmart in USD. Yeah. Anything else to add on this?
Yeah, so you can't just click on a flagship USD portfolio on the platform yet, but like what Yulin mentioned, you can use FundSmart, build your own portfolio, and pick income-focused funds as part of that. See what other questions that we have on Slido.
I saw a question on flagship fixed income and the yield. I guess the question is asking the yield for flagship fixed income portfolio. It's slightly lower than income portfolio. It doesn't have an income objective, so actually it takes a bit less credit risk, and it's really meant to provide you with diversification to equities. So it's and also lower risk to equities, and it has a core duration exposure, so it's longer duration than our income portfolios. The duration is over 5 years for now, and I'm just looking at. I think this is as of end of September. The yield is slightly above 6%. Yeah, whereas the income portfolios, the fixed income part of the portfolio, the yield is 7.8, 7.7%. Yeah.
But note that for the flagship portfolios, we use all accumulation share classes. So any interest that's received by the fund manager is automatically reinvested, and there's no payouts for that.
Yeah.
I saw a question on Amundi Global Aggregate 500 yield. So basically the benchmark.
Yeah, I think it's maybe I don't have the number straight off my head, but we can follow up. Actually, you can just go look for its fact sheets. You can go to our investment fund list on Endowus.com and search for this fund. Then we will have fact sheets there, and there will be the numbers over there. I think it will probably be between 5 to 6% because it's high quality. It's a blend of government bonds and investment grade corporate bonds. No high yield at all. So yeah, in that range.
Someone pulled it up. Thank you. Latest yield to maturity as of end of October is 4.73%.
Yeah, okay. Yeah, slightly lower than what I thought. Yeah. Yeah.
I saw a question on financial advisors. So we do have a team of licensed financial advisors. So if you have any questions, you can reach out to the team. You can go to support@endowus.com. You can reach out to us via WhatsApp or via email, and one of the licensed financial advisors will get back to you. Okay, are there any last questions? Please post them on Slido now, and we can address the questions. If not, we will wrap up the webinar for today. Okay, I think that's all the questions we have. Thank you everyone so much again for joining us for this webinar today during your lunch hour. Any follow-up questions, please feel free to reach out to my team and we'll get back to you on them.
Yeah.
Thank you and have a good day ahead.
Thank you.
Thanks, Yulin.